Okay, so you're saying that last week we were working on this assignment 2 with the joint op and the joint venture, and we had completed our calcs and we had completed our P&L, was it? We had to do a P&L. We had completed our P&L, and we did finish the P&L? Yeah. What happened to that? I must have had it somewhere. Yeah. So what we needed to do today was to finish this statement of changes in equity, and I think we had done a little bit of what goes into that statement of changes in equity. If we just go back here to the trial balance, we can see that there's a mark to market, retained earnings, share capital, and there would be NCI. Is that right? Okay, so if I was to look at that statement of changes in equity, then we'd have a beginning of year, movements, end of year, and we would have retained earnings, mark to market. Oh no, sorry, share capital first, right? Share capital, retained earnings, mark to market, and NCI, and then your various total columns, which I'm not going to bother with the total columns. So share capital is always just the company. Do you agree? So for share capital you had 200,000. Which was just the parent. No movement in share capital. So we start at 200 and we end on 200. Yeah. Retained earnings would be a calc. Is that right? So retained earnings, calc 1, would be the parent's retained earnings, 5,897,333. And then it would be the subsidiaries since retained earnings. When did we buy the subsidiary? During the year. So nothing for the subsidiary. And then it would be the since retained earnings of 10 do. And that we had worked out 183,848. So that's for 10 do. This was for AB. And then Senga, was that also acquired in the current year? Senga, we acquired 1 Jan. Okay, so it's just those two? Yeah. What was your number? 6 million? 181. Okay, so that was that one. Then mark to market. Mark to market, we were given for the company 178,974. Then we reversed out. We've got to take out everything that relates to 10 do, right? Yeah. 178,974. So I take out 178,974. What did you? The 1.2. Yeah. Okay. This here is the adjustment that Journal 1. You know that Journal 1, we have to take the investments back to cost. Yeah. So Tendu was a joint venture, right? we have to take it back to cost. Because the cost of Tendu was, what did we say the cost was when we bought it? 700,000. 700,000. But it's currently sitting in the books at 720. So this mark to market of 178974 would have needed to be reversed. So that's that reversal. Do you agree? So when we're looking at the statement of changes in equity, this 178974 is what I'm starting with. That's in AB's books. And then I have this reversal in AB's books. Yeah. And then I have the movement, the since acquisition movement in Tendu. And up to beginning of year. And then there's nothing else. Is that right? Yeah. So I'll end up with a minus 200, which is what you had. No.
I just minus the 100.
Yeah. Do you agree that I must reverse it?
Yeah.
So I'll end up with a minus 1,200 there. And then NCI, I would have started the year on nothing. Do you agree? Yeah. Okay. Then my movements, let me put my first movement in, which is my acquisition of a subsidiary. And when I acquired that sub, what was the amount of NCI there? That was like from lecture 1. It was the first lecture we did that, isn't it? Document 159,000. Shall I just go with that? A straight 159. Acquisition of sub 159. Like that. Okay. Then current year movements. Came off my P&L and OCI. So what did I have there? How much goes to retained earnings? 24 million. Yeah. 429. Mark to market?
31,631.
But how did we get that big number? Was there a movement in mark to market in one of the others?
There was in that Marlin, the 11,471.
So how do you get to 31? Oh, OCI 11. So how did you get to 30? How did we get to 31?
I did 2160 as well. 2160.
What was that? 20.
For,
The sub.
Yeah.
Okay. So this came off my P&L.
Yeah.
Okay, but I just want my piece. Is that just my piece?
The 11,471 is our piece.
No. What was NCI's? Okay, let's do OCI separate. Okay, what was NCI's share of profit? So my share was this my share or is this all of it?
No, that's my share.
Okay, our share, parents' share of profit, 2424429. NCI's share of profit?
Was 22,100.
22,100
Yeah.
of that 2424. 22.1,
Yeah.
like that. Okay, then total OCI was the 30 something, right? Okay, how much of that was parent and how much of that was us? You've got your split.
11,471.
No, because the parent also gets a share of the sub. Did we not? Did you finish this at home, this P&L?
No.
We did it in class.
Yeah.
So where's that bit that says attributable to? Didn't we do that bit?
Yeah.
Oh, there we go. There we go. Oh, okay, there we go. So the difference between the 22 and the 26 is what must go to sub.
Yeah.
Okay, so the total OCI was the 32 something. Some of it belongs here and some of it here to split it. Do you agree?
Yeah.
I don't know why I don't have. Did I not do the P&L on the board last week, or I did? I did. Let me see if I can find it. Lecture 5, huh? So why didn't I find it when I was going through it? And didn't I copy it across? I did, there it is. Why didn't I copy all of this? Oh, you know what? I even copied the wrong question, didn't I? When I copied it into here? Or not? It's the right question. Marlon. But for some reason, it was just the joint venture piece. I didn't copy the rest from last week's lecture. I think I copied the wrong lecture. So here's my P&L from last week, isn't it? This one. Copy. Okay. So here's my P&L from last week. So this over here was NCI's share of profit. This was parent's share of profit. The difference between these two is going to be the OCI piece. Do you agree? So the difference between these two is going to be the OCI piece. So the OCI piece is for the NCI is 4032. Is that right?
Yeah.
4032. And for the other one, it's 25 something? 27599 is the difference between the between those two numbers. And if you add them together, you get the 31.
Yeah.
This must add up to 31631. Let's just check. 24244 less 2. Okay. So now these are the two numbers that must go into statement of changes in equity for the OCI line.
27 goes
To market. And they both mark to market, same.
Yeah.
It's not a reval or anything like that. Now, what did I do with the statement of changes in equity that I was working on? It's disappeared. What the hell? I was just working on it. Let me undo. There it is.
Yeah.
I replaced it somehow.
Yeah, I think you pasted over.
I pasted over it.
Yeah.
That's nuts. Let me just go and get this one again. I really did, paste over it. Okay, what were the numbers here? Just give them to me again. It was 227,599 and 4032. Parent NCI. Okay, and this is the share of other comprehensive income, which is that number. Okay, so then if I go back to my statement of changes in equity, which is still here, then here I have a 4032 and here a 27599, like that. Okay, movement, P&L, OCI. Make sense? Okay, then I have dividends, or not?
Yeah.
I do. Okay, I have dividends. Did the subsidiary pay a dividend? The sub also paid a dividend. Yeah, the sub paid a dividend of 15,000. How much is the NCI's percentage share of that? 20. %. 20%. So 20% of 15 is at 3.
Yep.
3. Do you agree?
Mm-hmm.
Okay, and then the parent paid a dividend.
20.
A straight 20. The parent? 200. The other dividends we removed, do you agree?
Yeah.
So that goes there. In the retained earnings column, it's always the parent's dividend. In the NCI's column, it's the subsidiary's dividend that the subsidiary paid the NCI. The intercompany pieces, we eliminated. Do you agree? And then we total. I don't know. That one's 200. The other ones you can total up yourself. Does it make sense? Let's just check. Last week we did talk about what would be in each one. Let me see what I said. Yeah, that's more or less what I said. I think the only thing I left out when I was talking last week was this adjustment over here. I didn't talk about it, isn't it? This one, journal entry number 1. But remember, our mark-to-markets can never include the mark-to-market adjustments on our investments because those need to go back to cost so we can consolidate properly, isn't it? All of them must go back to cost. So if I have a subsidiary, an investment in subsidiary, it must go back to cost so I can eliminate. If I have an investment in a joint operation, it must go back to cost so I can eliminate because I do that journal. If I have an investment in a joint venture or an associate, it must go back to cost because that's where I start on. Hey, I start on cost. So whatever mark-to-market adjustments have been made in the parent relating to subsidiaries, associates, joint ventures, joint operations must all be removed. Yeah, so that's that removal, so that then the investment balances out properly. So that 178974 gets removed. So at beginning of year there was nothing actually, but we had an on-ac which reversed. So we have a minus. It's a funny minus, but that is what it is. And it relates to a joint, an associate, or an equity accounted one. Yeah. It's just our share, isn't it, that we've put in. Is that right? Yeah. That number's funny to me, but anyway, that is what it is. Associate. Yeah. Yeah. Okay, so statement of changes in equity is that. Last week we had done the P&L, so it was just a question of completing statement of changes in equity, which I asked you to look at home, and that assignment's done. Okay. The assignments are causing me a headache, all these different assignments in the different modules and the different due dates. But at least that one, I had actually ticked it off as being done, and from week to week I completely forget that there are pieces sometimes we haven't finished. All right, so today what I said we were going to do, because next week, let me just add a page here. Next week we are going to start changes in ownership, right? So if we look at what this module comprised, the module comprised IFRS 3, acquisition of subsidiary or acquisition of control, and we looked at where the parent acquires a subsidiary, and then in the second week we looked at the consolidation process and the intercompany transactions between the two that need to be eliminated, and we also looked in both of those weeks at the creation of this NCI and the fact that he owns some of the profit. Then in week 3, we looked where there's a sub-subsidiary and a second NCI, and this NCI who gets an extra piece because he gets S and he gets SS. Yeah, that was the second week. We looked at vertical subsidiaries. Then in week 1, week 2 was that was week 3. Then in week 4, we looked at associates. And we looked at the fact that we equity account associates. Associates is one line item in each of our statements. Investment in, and essentially we are the NCI. Parent equals NCI. When we have an associate, we are the NCI. We show them as one line, just like we show NCI as one line when we are the parent. And then in week, so that was week 4. In week 5, which was last week, we looked at joint arrangements. Yeah. So we looked at joint control, and we said joint control is either a joint venture or it's a joint op. If it's a joint venture, we account for it the same as an associate. If it's a joint op, we percentage consolidate, which is nice to do. We just take all the assets, all the liabilities, bring them in at our percentage. No NCI to worry about. Eliminate intercompanies the same way that we've done everything else. So that's what we've looked at so far. Now, what we're going to start looking at next week is we're going to look at when there are changes in ownership. Changes in ownership. Changes in ownership go backwards and forwards. So if we look at the different levels of ownership that we've seen here, we go from 0 to 30, we have an associate. We can go from there to 70, we have a subsidiary. We can even go from 70 to 90 and we just have a bigger subsidiary, isn't it? And we call those piecemeal acquisitions. You buy some, then you buy some more, then you buy some more, then you buy some more. And we're going to look at each of these transactions. What happens when I have 0 and I buy 30? That we've already done, isn't it? That's an associate. But what happens when I buy some more and then I have a subsidiary? And what happens when I have a subsidiary and I buy more shares and I'll end up with a bigger subsidiary? I also am going to look the other way. So I'm looking this way, which is called piecemeal acquisitions. I'm also going to look this way, which is if I have a subsidiary and I sell some of it, but not all of it, and I still have control, how do I account for that? And if I have a subsidiary, but I sell some of it and I lose control, how do I account for that? And if I sell a subsidiary completely, how do I account for that? Because I can also go from here straight to there, isn't it? So I'm going to look at forward movements and backward movements. Piecemeal acquisitions we'll do in 1 week. Then we'll do disposals in a week, which is the other way. We're going to start, the first disposal we do is actually when you sell a subsidiary completely. And then we're going to look at when we sell a piece of a subsidiary. These piecemeal acquisitions and disposals, we're going to focus mostly on the actual change transaction, isn't it? Just like the transaction where we acquired control. But from an accounting point of view, you have to account for an associate for part of the year, subsidiary for part of the year, isn't it? Whether you have an acquisition or a disposal. In week 3, so that's week 1 that way, week 2 the other way. In week 3, we're going to look at when there's changes in ownership because the company issues more shares, rights issues. So what can happen is that there's an NCI and there's a sub, the company issues more shares. Now, if they issue all their shares, this is the company. If this company issues more shares and issues all the shares to you, your percentage of the pie grows, isn't it? If they issue all the shares to them, their percentage of the pie grows. If they issue them in proportion, then the percentages don't change, isn't it? But the pie is bigger. So we have the same percentage but of a bigger pie. So we're going to look at those, which are rights issues, essentially when the parent issues shares. Yeah. Rights issues or just normal share issues, I guess, any kind of issue of shares by the company. So what I said we were going to do today is just take us to stop and practice some questions. Yeah. So I have a couple. They come out of type letter 103. Type letter 103. I suppose you have no type letters? Yeah. I've made some copies for you. Are they stapled? No. Okay, just let me see. Just check that. See what you've got there. And you've also got 2 question 10s. So there's an 11. So what you should have, I don't know how it came out, you should have page 66. And then you've got page 68. But no page 67. Okay, just give me them all back. Okay, now keep them because I'm going to put page 67 on the board, but I'll go and make new copies. Okay. So these are questions that are in Type Letter 103. You're going to get Type Letter 102, which has some additional questions, Type Letter 103, which has additional questions, and then sometimes Type Letter 201, which is exam papers. Okay, but this one, Type Letter 103, has these 2 questions, question 11 and 10. And we're going to start one and then see how it goes, and if we have time, we'll do both. So this one is a group called Rocky. When we start questions, the way that I like to start it is to just get a feel for what they're wanting me to prepare so that I can get an idea of more or less what I'm doing. And if you look, they want a P&L and OCI, and they want the retained earnings column of statement of changes in equity. Only that, not anything else. All right, then my next step is to try and draw a group structure and understand my year ends. So I can see from here that my year end is Feb 12, end of year. So beginning of year was Feb 11. Okay, and that's just to, like, when I see transactions so that I know where they occurred in relation to my year end. Then my next thing is to draw a group structure. So if I look at this group structure, I can see that there's a company called Rocky that owns shares in a company called Trail, and Trail owns shares in a company called Cliff. Do you agree? I have a vertical something, a vertical group of one kind or another. The other thing I can see is that it says that the investments are at fair value, which makes me think that there must be a mark to market. And when I look down, there is in fact a mark to market, and there's a deferred tax on the mark to market. Yeah? So you can see there's a mark to market there, and there's one there. So both of them, you can go back now and adjust the values, isn't it? So if we look at this one, it adds up to 30. And that one adds up to 15, it looks like, isn't it? So when we go back here to try and get back to cost, I'm going to say minus 30, minus 15, and that will be the first adjustment that I make, to the mark to market. Okay, what else do I see straight from the trial balance? I try to get a feel straight from the trial balance, is that I see dividends paid. So I know that I'm going to have to eliminate, especially these ones. These ones are going to eliminate, isn't it? The intercompany dividends. This one's going to land up in retained earnings in my statement of changes in equity. And in fact, I can go put it in straight away. Then I've earned the mark. Yeah? Because they ask for the retained earnings column. Okay, so then I have more or less a feel of what's here. I just want to get a feel for whether I have subsidiaries, associates, what I have. And when you look at the additional information, you will be able to immediately see whether you have one or the other. So what you'll see is that Rocky acquired control, so I have a sub, and Trail exercised significant influence. So it's an associate, yeah? So when I look at this group picture of mine, this one is a sub, this one is an associate. So my next step now before I do anything is to do my format. Yeah, my format. My format is my P&L and the statement of changes in equity retained earnings column only. When I do format, I can start to put in numbers. Do you agree? What numbers am I going to put? Parent plus sub. Then I have to have a line, investment in associate, isn't it, for the one at the bottom here. I must be careful because I have a piece of NCI. This NCI, whoever he is over here, he owns a piece of that company because we only own the rest. Because of this here, he also gets a piece of this. Do you agree? Whatever this percentage is, so let's say this is 30. The 30 doesn't flow all the way up there because he'll get 20 of that or whatever it is. So the same calc that we did when we did verticals, if it was a subsidiary, we still will do that calc, isn't it, when we do. So investment in associate will be the whole number. Sorry, profit from associate will be the whole number. When we do the NCI at the bottom, he must get a piece of that and we only get the rest. Yeah. So what you can do is you can work out effective holding if you want, or otherwise just make sure that you allocate. Whatever comes out of this associate here, you must split it between what will flow up to the parent and what won't, what will stick out that way. Make sense? Okay, you're going to give it a try? All right, so you're starting with your format, a P&L, and a statement of changes in equity, retained earnings column only. And you're going to guide yourself from whatever's on here. And if we look what's on here, they start with gross profit. There's gross profit, there's other income. Up there, there's other expenses. Then you're going to get to profit before interest and tax. There's some finance costs. Then you're going to put in share of profit of associate. Then you're going to have profit before tax, and there's some tax expense there, which leaves you with profit for the year. And then down here, there's some OCI, a reval. The subsidiary had a reval. Yeah? And then at the bottom, you're going to have that double whammy, so to speak. This one for the splits. Yeah, that split is a big split. Split of profit, split of total. You can even put split of OCI, split of total. But in essence, these are the two required disclosures. The split of profit, just P&L profit, and then the split of total. But we know that the difference between the two lands up in your NCI column and in your mark-to-market column. Although for this one, we won't need it. We'll only need the profit piece because we're only doing retained earnings. Do you want to work on the desk or are you going to work on paper? Okay. But you're going to work together, right? And give it a try. All right, so we've not seen one of these before, right? But we've done all the principles, so it should be a question of applying principles. A vertical group with a subsidiary and an associate. Right, so you're going to add Rocky and Trail, but not Cliff, hey, when you do your brackets. Okay. So you're going to start with that, with your formats and adding your numbers in. You can put your dividends straight into your calc. You can, for the retained earnings, start a calculation that starts with the parent's retained earnings, obviously. And then you're going to start doing the additional work. Additional work, 1, acquisition of Trail, 2, acquisition of Cliff. Let's see what else there is here, just so we have a feeling. No adjustments to assets. Then Trail sold a machine to Rocky. Remember, it's upstream. Upstream ones affect NCI. Trail sold to Rocky. Rocky issued a loan to Trail, so there's some intercompany interest and loans. Rocky sold inventory to Trail, so that one is a downstream. Downstreams are a bit easier. Rocky sold inventory to Trail. Oh, no intercompany transactions with Cliff, isn't it? All subsidiary intercompanies, no associate intercompanies. So it looks like the associate will be fairly easy to deal with, isn't it? Straightforward. All right. Let me see how that goes, and then we'll check. It's the first big question you're doing. Do you agree? Besides the assignment. So I'm okay if you want to go here and just pick off here what it must look like. Eventually when you write it, you'll know what it looks like, isn't it? But if you want to just get line items, you can get them from here. So line items are the ones that we talked about. And then you can start your brackets and put in the numbers. Where's the statement of changes? Is it at the bottom? Let me do a 2-pager. Okay, so that's just for format. which is what I expect you to be able to do as a starting point once you've got a feeling for what's happening in the question. Do you agree you have to get that feeling of the group structure and which one's associate, because otherwise you don't know what to add in your brackets, isn't it? Because now we know we mustn't add Cliff into our brackets. But if Cliff was, for example, a joint op, we would add a percentage of Cliff. Then we would go and check the percentage first. Can we have a look? How did it go? So. Oh, wait, I didn't. Oh, I did. Should have profit in associate, yeah. Okay, so these were my workings. Subsidiary, we acquired 1 December 08, and we landed up with a bargain of 4195. That should have been fairly straightforward. First lecture. That bargain of 4195 is before beginning of year. It's going to land up in retained earnings. We mustn't forget to add it in. It's profit. Then the movement in retained earnings to beginning of year was 130,824. Current year profit 154,926. OCI 17,908. Straight off the trial balance. Then the company sold, the subsidiary sold to the parent that equipment. The profit was 34.6 over 3 years, and then there are 9 months from June to beginning of year. So you needed to do 9 months there, 12 months there. So 34.6 reverse profit, bring in 9 months, bring in 12 months in the current year. Yeah, there, and there. Then the tax on the numbers. Yeah, so that should have been fairly straightforward. Reverse profit, bring it back over the life of the asset. Take it out where it belonged in retained earnings at beginning, bring it back in 9 months, 12 months, and do the tax. Yeah, remember, as profit increases, tax increases, profit decreases, tax decreases. Yeah, so in this case, profit dropped, so tax dropped as well. Or tax went the other way. Less tax. Less profit, less tax. Okay. Then there was one thing that I had forgotten to do, this pink one. There's a dividend that is sitting in other income in T, isn't it? Because we have that vertical group, because of the vertical group story. So when I look at this picture, Cliff paid a dividend to Trail. That dividend is sitting in Trail's other income. I'm going to reverse it, isn't it? We talked over here when we were looking at dividends that I was going to reverse the dividends. So when I must make sure that when I'm working out NCI, that I reverse that dividend, which I had forgotten to do. So it's one of the intercompany transactions, isn't it? It must be reversed. It's income in this subsidiary. Usually we don't see the dividend income in the subsidiary because it's in the parent, but because of the vertical group, there's income there. So there's a dividend received in this profit, which I'm going to reverse, so I must reverse it. Otherwise, I'm giving NCI profit that's not there. So I reverse it, and I land up with these numbers. Since acquisition, my profit drops, my retained earnings is 112,140. Current year profit drops to, or increases actually because of the depreciation reversal, 156,930. Yeah? And I give NCI their share. The NCI's share here is the 28,035, but I'm more interested in my share because I have to do retained earnings, isn't it? So they actually are more interested in my share. For current year, though, I'm interested in NCI's shares because NCI's shares is going into my P&L. Yeah. So the minute I do that, I can put those into my P&L, and then here's this dividend, which must be reversed. The 25.5 must be reversed in the parent. Let me change the color of that one. We make it pink. Well, I don't know what it's going to look like. Pink on top of green. Okay. Then for the associate, it was fairly straightforward, the associate. Again, I have to do an on-act just to check if there's a bargain. Yeah. In this case, there was a bargain. There was a bargain of 9.9. remember that when I have a bargain here, some of it must go to NCI, the rest feeds up to the group, isn't it? So that 99, 25% would go to NCI. Only the 7425 would land up in retained earnings, because I'm only going to take 75 of 35 into retained earnings, because that's the way it flows up. The movement in retained earnings here was straightforward. There were no intercompany transactions. Again, I'm going to take 75 of 35 into my retained earnings. Do you agree? The rest would go into NCI if you were asked to do an NCI column. Current year profit, 133,848. 35% is share of profit of associate, 116,847. NCI's share of that, which is going to go into the NCI piece, is the 11,712. And then I've got this dividend that I'm reversing over here, 6.3, which I had seen up there as well, up there, the 6.3. Then I had a couple more intercompany transactions. I had interest, which was fairly straightforward, 12.5%. And then I had this inventory, which I wasn't thinking, I was just plugging. And then I started to adjust the subsidiaries' numbers for it, but it's not money, it's not it's not an upstream transaction, it's downstream. So this profit belongs to the parent, to AB. So it doesn't go to NCI, isn't it? But there are some adjustments that go in our P&L to cost of sales, that and this, and then to tax expense, that and this, and then also adjustments to retained earnings over there. Okay, so we look at the numbers, how they flow then. Gross profit, parent plus sub, and gross profit gets adjusted with a minus 12 current year profit, unearned profit in inventory, plus 9 prior year unearned profit in inventory. Prior year comes in, current year goes out. Yeah. Then other income, parent plus sub, and then I'm reversing all the dividends. Yeah, the 25.5, which is 75% of the 34, and then the 6.3 that I had seen. And then I also am reversing the interest, which comes out of other income and comes out of finance cost. Share of profit from associate, 46,847. Is that the number it was? I said 116, but I think I was reading it wrong. Yeah, it's a 4, sorry. 46, 35% of 133. 46847. Yeah, share of profit of associate, 46847. Okay, so that's just one number. Other expenses. Why is there an adjustment there? 11. Oh, the depreciation adjustments, yeah, there we go. Depreciation adjustments in other expenses. Then the tax has all those adjustments in, isn't it? The depreciation piece, the opening inventory and closing inventory pieces in the tax. 11,533. Oh, that was for 9. Yeah, it's a different one. There I have a depreciation adjustment of 8,650, but in the current year I have 11,533. Yeah, it's 34.6 over 3 years, divide by 3, gives you for a full year 11,533. Tax on that 3,229. But do you see how they don't even work out the tax? In the tax thing, they just put the whole number times 28. And if you were doing the thing, that's the mark, isn't it? It's there in that calc. Although some students have said to me that they've heard that the UNISA lecturers don't mark this unless there is a number here. So if you're running out of time, just put any old number there, 100 all the way or something like that, isn't it? Because you want them to mark it here. This is where the marks are, 1, 2, or half, 3, 2, 3, 4, something like that. OCI was given. 17,908, it was a given number. Then profit attributable. We know that parents is the balancing figure, NCI is the non-balancing figure. We expect to see 2 bits for the NCI. We expect to see the NCI's 25% share of trail, and then the NCI's 25% share of the 35% share of profit in associate. Yeah. So when I look at my numbers, here it is. There's the NCI's share of this profit, 39,232. Then at the bottom, my share was 46, NCI's share was 25 of that. Okay, just don't be careful with which percentages you're working with, isn't it? There isn't in this case a second NCI. A second NCI would only be there if we had a subsidiary, but we don't. We only have one NCI, we only have one subsidiary, not two subsidiaries. This NCI gets 25% of the whole of Trail, and then 25% of 35% of Cliff. So it's the 39 and the 11, which works out to this 50-something number here, 15944. It's probably worth a lot of marks, that number. And then other comprehensive income, total comprehensive income, we're now just going to add their share of the 17. Yeah, their share of the 17. So because it was a reval in the subsidiary, isn't it? So this is 25% of that number. So I just add that into the NCI, and you'll see that the parent gets the other 75% of that number. Easy enough? Or you can follow it. And then in the retained earnings was quite a few numbers. I start with parent. Parent was straightforward. Then I have the two bargains, the 4195 and this my piece of that second bargain, the 7425, right? The two bargains. Then I also have the retained earnings beginning of year adjustment for the inventory, the -9 and +252, that one over there. Let me undo. Otherwise you can't read. So I start with I have parent, I have my two goodwills, my two bargains, not goodwills. I have the inventory adjustment, the 9 that came out and went to cost of sales. Then the only two bits that are left are the since bits for the two companies, the subsidiary and the associate. If I go to the since bits, for retained earnings beginning of year, there was the adjustment for the plant. So the since bit is the 84,105. Yeah. I started with a movement of 130. I remove the profit, bring in 9 months of depreciation and tax. I land on 112,140. My 75% share, 84,105. And then down here for the associate, I have a movement of 76,734. My share is 35%, but the parent's share is 75 of 35. 75 of 35, 20,143. So when I do my calcs, or when I look at my numbers, I add the 84, I add the 2143, and I come out at that number, 303712. If you look at how they work out this 303712, it is a convoluted, because I was out by 15 Rand, because I'd added wrong. So I was trying to figure out where it was out. If you look how it all flows, the 313 comes off Calc 1. Calc 1 is here. So in Calc 1, they've got Rocky, and they've got Trail, and they've got the bargain, and they've got the inventory. So Calc 1 is here. But then for Trail, it goes to Calc 2. So Calc 2 is here. Then Calc 2, you'll see, has Trail, and then it has the bargain purchase for gain for Cliff, and then it has retained earnings for Cliff, which comes off Calc 3, and then has the machine stuff. Yeah. Then they take that number and they times it by 75% to get that number. Then you have to go to Calc 3. When you go to Calc 3 and you look at that number that they're pulling through, it was this one, hey, 2143? Is that what it was? No, 111673 is what comes. No. 26857 is the number that comes from here. Which is this one. 26857, which comes from Calc 4. Then you have to go to Calc 4, and Calc 4 is the analysis for Cliff. And when you get to Calc 4, you see here's the 26857, which is my share of the movement of the 76. It's a drama, isn't it? So you'd have to start with this analysis. This analysis is half a page or just over half a page. Then from this analysis, they pull these numbers here, these since numbers, they pull them into this analysis, and then they bring it in here. Then it gets shared again, do you see, between the two, and then they take these numbers, and then they still do a calc to get the retained earnings. For me, it's just convoluted, isn't it? And that's the thing with analysis. In second year, the analyses are straightforward because it's just one, and it's when you get to honors and the analysis start to be convoluted, what I was finding is that students were struggling to figure out how to put things on the analysis. And I'm like, but don't worry, but why are we worrying about the analysis? Let's try and worry about what should be in my P&L, isn't it? Or in my statement of changes in equity. And if we look at principles, which is what I want you to think of, if we think what should be in retained earnings at beginning of year, it's the parent, my share of the since of the subsidiary, my share of the since of the associate, which happens to just be a piece of a piece because it's vertical. But it's always the parent's perspective, eh? So 100% of me, 75% of the subsidiary, 75 of 35 of the associate because it's vertical. And then the bargains, and then any unearned profit that the parent has of unearned profit would go in there. Because any of the subsidiary or associate's unearned profit would be adjusted in their numbers like it was with the equipment. Yeah. So that number, you can imagine, would be worth a lot of marks. How much do they say is Part B? How many marks is Part B? Do they say marks? 14. And that's going to be the bulk of the 14. Do you agree? Because this number pulls from A. Whatever you had in A, they'll give it to you. So let's say that's a mark and that's a mark. So 12 marks is that 303. Yeah? So you must just make sure that you're able to say where your numbers are coming from, isn't it? And that you're able to reference them properly. Okay. So an associate, a vertical group with an associate in it. If you just keep your wits, isn't it, and do your calcs. What you see that I did here, which when we are first doing our workings, I usually do this movement and give NCI straight away. Don't give NCI straight away. Do the rest of your intercompany stuff. Then do the NCI when you get to the end. Yeah. Yeah. So that was that one. Let's do it. Let's look at the next one. I don't know if we'll have time to do it. No, we don't have time, but we can have a look what the question was. Question 11, which you also have, which you can practice at home if you want, is 3 companies. It's a rainbow group, rainbow, red, and blue. And what you can see is that rainbow has an investment in red and green. So Rain has red and green, and then red has an investment in blue. So it looks like that. Rain, red, green, blue. If we look at the information, we have control of red. And Rainbow sold inventory to Red, but that's okay because that's the parent making the profit, isn't it? It's always the same intercompany stuff. And then Red acquired Blue. They have joint control, and they say it's a joint op. So Blue's a joint op. Red is a subsidiary. And then Green is a joint venture. A joint venture. This one looks similar to our assignment question in a way, but we didn't have a vertical. Hey, ours was all horizontal. So when we go back here, this is a sub, this is a JV, this is a joint op. Is it the other way? Blue's a joint op. Yeah, you're right. Blue was a joint op. This one was a JV. Joint op. JV. Okay. Let's see what they ask us to do. They ask you to do pro forma journal entries for the joint op. Just for the joint op. for 18 marks. How easy are those? So easy. If you get that in the exam, you're going, wow, 18 marks for joint op journals, and then another 27 for the P&L. We've just done a P&L, isn't it? So it's not going to be much different to our P&L. How does this P&L look? Parent plus sub, rainbow plus red, plus percentage of blue, and then plus the line item for green. Yeah. Let's just look at those journals quickly. It starts here. For 18 marks, look. We reversed the mark to market. There obviously was a mark to market. It's always the first entry, yeah, reverse mark to market. Then there's the entry just to bring in the trial balance. As it stands, boom, 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 boom. Then there's the basic elimination entry, in this case, not even any goodwill or anything. Reverse share capital retained earnings, reverse investment, it reverses no goodwill, nothing. And then there's an elimination of a management fee paid between the group, other income, other expenses, percentage only. 18 marks for that. It's like marks for jam. Do you agree? Absolute marks for jam. Then what they'd like to show is this. Journal 2, 3, and 4 combined. Don't do that. Because you get yourself into such a state about what should be there and what shouldn't be there, isn't it? So remember our principles for joint ops and journals. Always reverse the mark to market. That's for everything. Reverse the mark to market first to get it back to cost. Get your investment back to cost. Bring in the trial balance as it stands. Do a little on AC. The on AC won't have NCI and everything will be in at 50%. It may have goodwill, it may have bargain. In this case, it had neither. And then do your intercompany adjustments. And intercompany is the same as group, except it's my percentage only. And I don't have to worry about NCI and direction and whatever. So that one was fairly straightforward. And then they had a P&L, which I imagine most of the marks in the P&L. Let me see how many adjustments there are. You can see, look, parent, sub, 50% of joint op. Parent, sub, 50% of joint op. There's obviously some intercompany. There was intercompany sales, in and out there. There's the unearned profit of 16 there. Then other income. Parent, sub, 50% of joint op. Then there's that adjustment for the 30. We saw the journal. And I think this might be dividends. Other income, I'm not sure. Share of profits of joint venture. They even gave you the profit. All you have to do was times it by the percentage. Other expenses, parent, sub, 50% of joint op. There's the 30-year adjustment as well. Then the tax is just the adjustments for the things we put at the top. OCI. There's some OCI. The joint venture has some OCI. Yeah. Again, just our share, 40%. I mean, 27 marks for that. And then we split it, owner, parent, owner, parent. Yeah? Okay. One of your questions in your exam will be like this. It might be like the first one. It might be like this one. It might have journals in it. It probably is likely to have journals in it. But it will be a group, a mixed group with, we saw earlier, a vertical associate and subsidiary. Might have a joint op or a joint venture. Might be like this one. There will be some intercompany transactions, and they will ask you to either do journals and prepare a piece of something. So they like the statement of changes in equity, but here they didn't ask that. They asked journals and a P&L. The other one was P&L and statement of changes. One of the questions will be that. The other question will be a change in ownership question. If there are 3 questions, the third one might be a cash flow. Otherwise, in the change in ownership question, they will ask a little bit of cash flow. Because that's when we have cash flows for subsidiaries, when we change ownership, isn't it? Why? I'm paying cash to get more shares, or I am selling and receiving cash. So we see those cash flows happening in group. Okay, so next week we're going to do changes in ownership. We call it piecemeal acquisitions. We now buy a little bit more, a little bit more, a little bit more. But you're feeling better than you were last year. It's to be expected because we want it to get better and better. But I can promise you that a lot of students or some students feel like, oh, they must rather go back to analysis because it's more like copy-paste. But then when you start to get to changes, then I had a student that the 1 year decided just before the exam that he was going to start doing analysis. And then when he got to the exam, he said he didn't know, he couldn't remember, he couldn't figure out where to put stuff, where to pull it, where it went. And because you're not thinking what's supposed to be happening, the logic, you're just thinking color by numbers, then unless you know it, you have no idea. Yeah. And you can see it's lots of, I think it's more work. Yeah. If you do it, you have to be able to go like a Boeing, super fast.